October 29th, 1929, Black Tuesday. The New York Stock Exchange erupts in chaos. Over 16 million shares change hands in a single day, a record that stood for decades. The Dow Jones plunges 12%, vaporizing billions overnight. Brokers scream sell orders as crowds swarm outside, fortunes evaporate, and whispers of suicide ripple through the trading floor. One investor loses $30 million in hours. Another, a shoeshine boy who'd been giving stock tips, is ruined. In weeks, the market sheds nearly half its value. This wasn't just a bad day on Wall Street. It was the spark that ignited the Great Depression, a decade-long catastrophe that plunged millions into poverty, toppled governments, and reshaped the world. How did the greatest economic boom in history turn into the worst collapse? This is the story of when the market truly lost its mind. To understand the fall, we must go back to the beginning. The aftermath of World War I, Europe lay in ruins, indebted to America for billions in war loans. The United States, unscathed by the fighting on its soil, emerged as the world's economic superpower. Factories shifted from wartime production to consumer goods, automobiles, radios, refrigerators. Henry Ford's assembly lines revolutionized manufacturing, churning out Model Ts that put America on wheels. The 1920s roared with optimism. Prohibition fueled speakeasies and jazz. Women bobbed their hair, voted, and danced the Charleston. This was an era of innovation. Electricity lit homes, airplanes crossed oceans, and talking pictures arrived in theaters. Economic growth averaged 4% annually. Unemployment hovered around 3 to 4%. Wages rose for many, and consumer credit boomed. By now, pay later became the mantra. But inequality shadowed the prosperity. By 1929, the top 1% owned 24% of the wealth, the highest in history. Farmers struggled with overproduction. Crop prices plummeted after Europe's agriculture recovered. Rural America faced foreclosures while cities glittered. President Calvin Coolidge embodied laissez-faire. Government stayed hands-off. Taxes were cut for the rich, and regulation was minimal. Key figures shaped the scene. Herbert Hoover, Secretary of Commerce, promoted voluntary business cooperation. Economists like Yale's Irving Fisher proclaimed stocks had reached a permanently high plateau. The Federal Reserve kept interest rates low, flooding the system with cheap money. Banks mixed commercial lending with risky investments. All this set the stage for speculation to run wild. Stock market became America's national pastime. From 1921 to September 1929, the Dow Jones Industrial Average soared from 63 to a peak of 381, a staggering 500% gain. Blue chip stocks like General Electric tripled. Radio Corporation of America, RCA, exploded from $1 to $114 per share, driven by the radio boom. Everyone joined the frenzy. Millionaires like John D. Rockefeller invested heavily, but so did ordinary folks, teachers, clerks, even janitors. Shoeshine boys traded tips on the curb. By 1929, over 1.5 million Americans owned stocks mini for the first time. The fuel, margin buying. Investors needed only 10 to 20% down. Brokers loaned the rest at high interest. Up. A $100 stock could be bought with $10 cash. If it rose to $200, profits doubled after repaying the loan. Margin debt ballooned to $8.5 billion, more than a U.S. money supply. Investment trusts amplified the mania. These funds pooled money to buy stocks, often leveraging further. Goldman Sachs Trading Corporation layered trusts upon trusts, creating pyramids of debt. Speculators bet on endless rises. Pools, groups of insiders manipulated prices, pumping stocks before dumping them. Cultural euphoria fed it. New era thinking dismissed old valuations. Innovation would drive perpetual growth. President Hoover elected in 1928, declared poverty soon vanquished. In September 1929, economist Irving Fisher reassured, stock prices have reached what looks like a permanently high plateau. The bubble swelled. Detached from reality, corporate earnings couldn't justify the valuations. Cracks appeared early. Industrial production peaked in June 1929, then declined. Overproduction flooded markets. Unsold cars piled up. Inventories rose. Consumer debt-burdened households' installment loans hit $6 billion. Agriculture faltered. Wheat and cotton prices collapsed. Farmers defaulted en masse. International strains mounted. Britain struggled on the gold standard. Europe owed America $10 billion in reparations and loans. The Fed tightened in August 1929, raising rates to curb speculation. Margin calls pressured borrowers. September saw volatility. The Hattree fraud scandal in London shook confidence. October brought warnings. On October 3rd, Fisher reiterated optimism, but selling accelerated. Black Thursday, October 24th, panic hit. 12.9 million shares traded a record. The Dow fell 11%. Ticker tapes lagged hours behind. Bankers like J.P. Morgan's Thomas Lamont organized a $240 million pool to buy blue chips, stabilizing by day's end. Relief was illusory. Over the weekend, fear festered. Hidden vulnerabilities, over-leveraged banks, inflated prices, fragile global ties loomed. The intervention masked the rot. Confidence teetered. Monday, October 28th, Black Monday. Selling resumed fiercely. The Dow dropped nearly 13%, or 38 points, another record loss. Tuesday, October 29th, Black Tuesday. Chaos peaked. 16.4 million shares traded. No buyers emerged. Prices free fell. The Dow plunged another 12%, closing down 23% in 2 days. By mid-November, the market lost $30 billion, 10 times the federal budget. Panic cascaded. Margin calls forced sales, driving prices lower in a vicious cycle. Banks, heavy in stocks, faced ruin. Depositors rushed withdrawals. Over 9,000 banks failed by 1933, wiping out savings. Trade collapsed. The Smoot-Hawley tariff, June 1930, raised duties to 60% on imports, aiming to protect farmers and industry. Retaliation followed. Global trade fell 66% from 1929 to 1934. Industry cratered. Production dropped 47%. Steel mills idled. Output halved. The Dust Bowl ravaged the plains. Droughts and poor farming eroded soil. Black blizzards buried farms. 2.5 million fled, many to California as Okies. Human toll mounted. Soup kitchens fed millions. Hooverville's shantytowns sprang up, mocking President Hoover. Families doubled up. Evictions soared. Birth rates fell. Suicides rose 30%. Globally, contagion spread. Europe, reliant on U.S. loans, faced recalls. Germany's reparations burden crushed it. Unemployment hit 30%. Britain's gold standard abandonment in 1931 devalued the pound. Authoritarian regimes rose amid despair. The Depression's depth stunned. U.S. GDP shrank 30% from $104 billion, 1929 to $57 billion, 1933. Deflation hit 25%. Debts ballooned in real terms. Worldwide output fell 15%. Hoover's response: voluntary aid, public works like the Hoover Dam, and the Reconstruction Finance Corporation, 1932, to lend to banks. McKay resisted direct relief, fearing dependency. Critics called it too little, too late. In 1932, Franklin D. Roosevelt won a landslide, promising a New Deal. His first 100 days unleashed reform. Bank holiday closed failing institutions. FDIC insured deposits. Glass-Steagall separated commercial and investment banking. SEC regulated stocks. Relief. Civilian Conservation Corps (CCC) employed 3 million young men in conservation. Works Progress Administration (WPA) built roads, schools, airports, employing 8.5 million. Agriculture. AAA paid farmers to reduce output, raising prices. Social Security 1935 provided pensions and unemployment insurance. Recovery lagged. A 1937 recession hit when FDR cut spending. Unemployment stayed above 14% until 1940. Full recovery came with World War II. Defense spending soared. Factories hummed. Unemployment vanished. Winners. Labor gained rights via Wagner Act. Safety nets endured. Losers. Millions scarred by hardship. Minorities and women suffered disproportionately. Globally, the Depression fueled extremism. In Germany, it propelled Hitler's rise in 1933. Economic despair birthed fascism and set stages for war. Lessons. Speculation unchecked breeds bubbles. Protectionism worsens slumps. Government can stabilize via countercyclical policy. Monetary flexibility matters rigid, gold standard, prolonged pain. The Great Depression wasn't inevitable, but a chain of excesses, misjudgments, and policy failures from margin-fueled mania to tariff wars turned prosperity into prolonged agony. It exposed capitalism's vulnerabilities, birthed modern regulation in welfare states, and reminded humanity that economic hubris can unleash decades of suffering. In every boom since, its shadow lingers. Markets can lose their mind, but societies can learn to temper the madness.